If you're like most people, you've probably heard plenty of commentary recently about how the stock market is overvalued and you should be expecting a big correction soon. Possibly, you've even seen articles like this one. Check out this headline. The S&P 500 is going to plunge at least 30% based on what a forecasting tool with a 100% historical success rate has to say. This article came out just this past weekend, July 26, 2025. It came out shortly after I posted a video about market valuations and how they're measured using the CAPE ratio. But that video now needs a follow-up because we need to address this and some other things that have happened since then. So I'm going to quote from the article. The valuation tool with an uncanny track record, 100% success rate of forecasting future stock returns is the S&P 500 Shiller's PE ratio, referred to as the CAPE ratio. The article states, following the previous 5 occurrences where the Shiller PE topped 30, the S&P 500, NASDAQ Composite, and or Dow Jones Industrial Average fell between 20 and 89%. And then I like this statement. Based solely on what this valuation forecasting tool tells us, Wall Street's benchmark index can lose 30% of its value at some point in the presumed not too distant future. I'm really not sure what to make of that, but it's pretty vague on the old timeline there. I can say at some point in the future, we'll have a 30% correction, okay? Because historically, 10% of years will have a 30% correction. So I'm not sure what we're supposed to do with this, but certainly you should not be taking any action based on what the CAPE ratio is and or any time it's above 30. So the CAPE ratio is not a market predicting tool, especially in the short term. It is meant to be used as giving an indication, kind of a probability of what the rates of return for the S&P 500 might be over the next 10 years, okay? Not any time in the short term. Now, should we be worried though when it is above 30? Well, let's take a look at this. In January 1 of 2024, the CAPE ratio was over 32. And the S&P 500 went up around 25% in that year alone. In January 1 of 2021, the CAPE ratio was over 34. And the S&P 500 went up almost 29% that year. Anybody that would have been worried about the CAPE ratio being above 30 at the beginning of these 2 years would have missed out on some huge returns if they sold out or, didn't invest during those years and things like that. So we want to be very careful listening to the clickbait headlines like that last article that we just looked at. Now, I also want to look at some stuff back in 2014 and 2016. Okay, Robert Shiller is a brilliant economist, Nobel Prize winner in economics, professor at Yale, but he has a difficult time predicting the future too. So when he was being interviewed back in 2014 on CNBC, he stated, talking about the CAPE ratio, stated that it's at 26 now, so it's a little higher than the average, and he was comparing it to the past years. That looks a little like a bubble as well, so the whole thing might correct down both bonds and stocks. Now, in 2013, the Wall Street Journal wrote of a rising concern among market watchers that stocks are being lifted by a potentially dangerous bubble, with Shiller's index seen as one of the early warning signs. In 2016, the Wall Street Journal published an article titled, "Stock Valuations Flash a Warning Sign," when the CAPE ratio rose above 27. In that article, readers were reminded that when the CAPE ratio reaches its top decile, the S&P 500 averages around 4% annually for the following decade. Now, let's see how the Wall Street Journal and Robert Shiller did with their predictions. Let's look at the last 10 years. January 1st of 2015 through December 31st of 2024 is a 10-year period. The S&P 500 had a compounded annual growth rate of 13.13%. It's very difficult to predict the future, okay? And Even somebody like Warren Buffett has always said he has no ability to predict what the market might do over the next year or two. Okay, so we want to be very careful listening to this kind of advice. Okay, we also want to be very careful reading and paying attention to that clickbait article that came out this past weekend. Now, having said all that, there is no question by historical standards, we are at high valuations. Okay, so typically, historically, going all the way back to like 1880, the average CAPE ratio is about 17. If I look at the last few decades, the average is about 24. But we are currently at about 39. And the only time it has been valued higher is right before 2000, the year 2000. And of course, that was referred to as the dot-com bubble. And the market dropped 3 years in a row. So this is what people are referring to when they say the stock market is, possibly overvalued and you should have concern. So what I want to look at now is, is that historical reference relevant? So I'm going to point out 7 limitations of the CAPE ratio and why it may not be a very good measure historically compared, to what's going on today. Now, let me take a quick moment to say I'd really appreciate it if you hit the like button and leave me some comments below. I'd really like to hear your thoughts afterwards. All right. The first thing, the CAPE ratio assumes a constant mix of stocks over time. Well, that's completely ridiculous because we definitely don't have that. Let's go back to 1990. Here's the top 10 companies of the S&P 500. IBM, ExxonMobil, GE, Philip Morris, Shell, Bristol Myers. And all of them, have a relatively low percentage. IBM was 2.9% of that index. ExxonMobil was 2.9. So they didn't, even the top 10 companies didn't really make up that much of the overall index. In the year 2000, we had companies like GE in the top 10, ExxonMobil, Pfizer, Cisco, Citigroup, Walmart. So again, but relatively small portion of the overall index. In 2010, ExxonMobil was still in the top 10. We finally got a couple of tech companies here. We got Apple and Microsoft moving towards the top. But notice even Apple was only 2.6% of the overall index. Microsoft was 1.8. But then we had Chevron, IBM. These types of companies are in industries that typically grow rather slow and they have smaller profit margins. Now, let's look at 2024. Apple made up 7% of the index. NVIDIA came out of nowhere, a chip company, 6.4. Microsoft, 6.4. Alphabet, that's Google, 6.2. Amazon, 3.8. Meta, that's Facebook. We have Broadcom, a chip company. We have Tesla. Notice it's very tech heavy. And besides that, these companies are growing extremely fast compared to the others. They have much higher profit margins. And notice then, just these top 10 companies right now make up about 33% of the overall index. It's nowhere close to the type of companies that we had back here. So that historical reference really doesn't make much sense. In fact, for the second quarter of 2025, the tech giants are still expected to have a collective earnings growth rate of slightly over 14% compared to the remaining 493 companies in the S&P 500, which are projected to grow at a more modest 3.4%. This is just an example of how fast these are growing compared to these types of companies. So again, we are not even close to the same mix of companies. Now, the next thing, number 2, the tax policies have changed. In 2017, we had the Tax Cut and Jobs Act that lowered corporate taxes, which helps corporations hang on to more of their profits. So we shouldn't really compare, the companies of today with companies years ago that had higher corporate taxes. Also, the CAPE ratio fails to account for share buybacks. Instead of paying out money through dividends like they used to, companies now often buy back their own company shares. This boosts earnings per share, which can make companies look more profitable, even though their total profits haven't changed. Let's look at the dividend rate, the dividend yield that the S&P 500 has been paying. Back in the 1980s, it was pretty common for the S&P 500 to pay out a dividend yield of between 4 and 6%. But that has been dropping steadily. And right now, we're all the way down to about 1.2%. So companies are not giving away as much of their profit to shareholders. They're hanging on to that, reinvesting it into their own business or buying back shares. So again, this is just another example that it doesn't really make much sense to compare the companies now with the companies decades ago. Number 4 reason, low interest rates. I know interest rates have gone up recently, but historically, we are still slightly below the average. In fact, back in the 1980s, the interest rates averaged between 10 and 18%. So historically, we are slightly below the average. So we have what's called the discount effect. Lower interest rates reduce discount rate, which is used to value future earnings, which boosts the present value of stocks. The result, comparing a current CAPE ratio with a CAPE ratio of maybe back in the 1980s, when interest rates were between 10 and 18%, is very misleading. Number 5, the CAPE doesn't adjust for accounting changes. There has been a couple different major accounting changes of how companies have to record things. Now, the way companies report earnings has changed over time. There's been 2 major changes. Some of today's rules are stricter and treat certain costs differently. That means that older earning numbers used in the CAPE may not match up well with today's way of accounting. So again, just one more reason why it doesn't make a lot of sense to do this historical comparison. 6, improved profit margins. Businesses today often make more money for every dollar of sales than they did in the past. This is thanks to technology. Maybe they've exported labor to countries with lower labor costs. We have global supply chains. Companies have become more efficient. If businesses earn more, people are willing to pay a higher price for those earnings, which raises the CAPE ratio. Productivity enhancing technologies like artificial intelligence. A lot of people are predicting that's going to play a major role here and boost future earnings. That could justify higher CAPE ratios. Also, for individual investors, the cost of commissions have collapsed. Now more and more investors are using index funds and ETFs, which have much lower expense ratios, meaning that investors are capturing more of the gross return of stocks, justifying higher valuations. And reason number 7, modern businesses have a lot of invisible value. Today's big companies like Apple, Google, Microsoft get a lot of their value from things that you can't see on a balance sheet, like their brand name, software, data, patents. Traditional measures of CAPE don't fully capture that value, which can make stocks look more expensive than they really are. Decades ago, the market had more factories, banks, energy companies, industrials that grow slow and are cyclical and had smaller profit margins. Now, that doesn't mean, after having said all that the market isn't highly valued. By all historical measures, it is. But the historical measure that they're using, we just went through 7 reasons why it may not be relevant to be using that measure. But that doesn't mean that you shouldn't expect a correction. A correction is part of investing. So in 95% of years, we have a 5% or more correction. 63% of years, 10% or more. Notice here, 10% of years, a 30% or worse correction happens. So corrections happen. But if you are consistent and you are just investing consistently month after month after month, when those corrections happen, it really gives you an opportunity to buy things when they're on sale for a while. And that's going to help you in the long run. Now, of course, any money that you might need to use or get access to in the next 2 to 5 years probably shouldn't be in stocks. It needs to be in something stable. But your stock investments are a long-term endeavor, and you should expect corrections. They happen regardless of what the CAPE ratio is, and you should just look at those as opportunities to buy things when they're on sale for a while, and definitely just keep investing. You cannot time the market, and you shouldn't be trying to use tools to predict any kind of a market correction. Okay? Now, that being said, we have had a couple remarkable years. In 2023, the S&P 500 was up over 26%. In 2024, it was up over 25%. And this year, we are up again. So this can't continue, not these kinds of rates of return. So we are going to have a correction at some point. I don't know if that'll be this year, 3 years from now, 4 years from now, but corrections happen. That's part of investing, and you should expect that. And you don't want to react or panic when that happens. Okay? What you want to do is take a long-term view. This is a 100-year chart, a logarithmic chart of the S&P 500, which a logarithmic chart shows us the percentage change as we go across time. So notice here we have corrections. Here's the dot-com bubble where it went down 3 years in a row. Here's the housing crisis. Okay? But in general, the market always goes up left to right, and there has never been a 20-year period where the S&P 500 has lost money. So you want to take a long-term view. Don't try and use any silly predicting tools of what the market may do. Okay? You don't want to try and time the market. You want to have a plan, stick with it, and be consistent. And in the long run, you're going to be very happy you did. So I hope this video has been helpful. Please hit the like button, and I would really like to hear your comments below. Thank you for watching.